In this video, we will discuss about the admission of a partner. And this is a very short video. I have not discussed about the other things. This video is primarily focused in making of various accounts, which includes revaluation account, partners capital account, and the balance sheet. Okay. So we already know making of partners capital account and the balance sheet. So I have not discussed here in this video, but I have talked about revaluation account, which is the important account that we have to prepare. Okay, so let us see how a partner can be added. So as you can see on your screen, that a partner can be admitted in two cases: when the partnership deed is present, and in there it will be mentioned on what conditions a new partner can be admitted. Okay, on number two case, that in the absence of above, which means when the partnership deed is absent. We have already seen in the previous video that the partnership deed may be absent. So in that case, under the mutual consent of all the partners, a new partner can be added. So now let us see rights of the new partner. So what are the rights that a partner can enjoy after being admitted in the partnership firm? So number one, right to share future profits in the firm. So he will be able to share profits in the firm afterwards. Okay, not only as the profits, but he has to share his amount of loss also. Okay, so he will also have the right to share in the assets of the firm. Okay, so he will be able to use the assets of the firm. Okay, but for the purpose of the business. Okay, so what are the effects of admission of a partner? So when a new partner is admitted in the business, the existing partnership comes to an end. By partnership, I mean the agreement. Okay, so the existing partnership comes to an end and a new partnership comes to existence. So it doesn't mean that the firm will be dissolved. Okay, the firm continues to remain. If the firm is engaged in selling shoes, they will be uh, continuing in their business of selling the shoes, but the the old partnership comes to an end and a new partnership comes to existence. By partnership, again, I'm repeating, by partnership, I mean the agreement. Okay, the old agreement, it will come to an end and a new agreement is formed. Okay, so when a new partner becomes, when a new partner comes to the business, he will be entitled to share profits, as we have already discussed here also. Okay, so and the combined share of all partners gets reduced. Okay, so when the new partner comes in the business, he will be getting some amount of future profit, but the combined share of all partners gets reduced. So how is this? Okay, let us see here in this pie chart. As you can see here, with this blue, okay, this blue area has been marked as the share of A, and the orange area, maybe this is orange, yeah, maybe orange or yellow, whatever, is the area, is the share of B. So let us suppose that the old partners were A and B. Okay, and they were sharing the profits in this ratio. Okay, so when a new partner is added, okay, when a new partner is added in the business, as you can see here, a new partner is added, isn't it? Partner C. So when a new partner is added, so the share of A and share of B will be reduced, as you can see here in this picture. Okay, as you can compare these two pictures, let us suppose that this entire this is one is uh, a bread. Let us suppose that. Okay, uh, when A and B were sharing a piece of bread in such ratio, then if the new partner is added in the business, okay, let us suppose a new partner, that is C. If new partner is added in the business, then out of the amount of, I mean, the out of the amount of the share of A and B, they have to give some portion to C. They have to now share with C also. So the existing share of A and B will be reduced. Okay, so when new partner is admitted, he contributes a certain amount of capital in the business, which will be agreed in the partnership deed. Okay, or they will agree if there is no partnership deed. Okay, so now when the new partner comes in, he gets right on the assets of the firm, as discussed here also. Okay, but he will be at the same time liable for the liabilities of the firm also. By liable, we mean responsible. Okay, so he will be responsible to pay off the liabilities of the firm also. Okay, so when a new partner is admitted, the adjustments should be made for reserves or accumulated profits or any losses is there. Okay, accumulated loss or profit. By reserve, we mean a certain amount of profit which has been set aside for the future use. And by accumulated profit, we mean the profit that has been accumulated, that has been deposited for many years, which was not distributed among the partners. So when a new partner is admitted, this accumulated profit should be shared between the old partners or the existing partners as per their old ratio. Because in the accumulated profit or the reserves or in the accumulated loss, new partner has no share. Okay, that is why it should be adjusted when a new partner is admitted in the business. So now, when a new partner is admitted, assets are to be revalued, because we have already seen that when a new partner is admitted, the old partnership comes to an end, which means the existing partnership comes to an end. So a new partnership comes to existence, which means a new partner has been added, isn't it, in the business. So now, at this point of time, when a new partner is added, he is bringing certain amount of capital. So the amount of capital increases, as well as the amount of asset also increases, because a new partner brings in amount of capital in form of cash or bank, isn't it? So capital as well as the liabilities, they increase. So at that point of time, the assets and the liabilities are to be revalued or reassessed. So now, when profit or loss arise out of revaluation of assets and liabilities, it should be adjusted between the old partners as per their old ratio. Okay, so by old partner or existing partner, we mean same. Okay, so when there is profit or loss which arise out of it, okay, at that point of time, the partners are to share such profit or loss as per their old ratio. Okay, here also in this profit or loss also, the new partner has no share here. Okay, now, goodwill of the firm is to be valued and has to be paid to the sacrificing partner for their sacrificing ratio by the gaining partners. Okay, when new partner is coming in the business, so he is to give certain amount of uh, premium for goodwill, isn't it? He is supposed to bring in, isn't it? So the certain amount of goodwill is to be now shared between the sacrificing partners, because they are sacrificing, as we can see here, as A and B are now sacrificing certain amount of their share, isn't it? That is why this A and B are to get the amount of goodwill. Okay, now let us move on. Maybe this is the yes, maybe this is the last one. Okay, so uh, we have to prepare a revaluation account. Okay, so I have not mentioned here profit or loss. I will tell you afterwards in this video only. Okay, so we have to prepare a revaluation account. Okay, so in revaluation account, what do we do is that whenever there is a decrease in assets, we record in the debit side. Okay, if any asset is decreased, then we have to record in the debit column. If any machinery is decreasing, we have to record in the debit column or the debit side. And if the same asset or machinery or stock or furniture or any form of other fixed assets are increasing, then we have to record in the credit column or in the credit side. Okay, and same applies, just the opposite for the liabilities. If any liability is increasing, then it should be recorded in the debit column. If any provision is increasing, for example, you are creating provision for doubtful debts or bad debts for the first time, okay, then you have to record in the debit column. Okay, now if the same provision is being decreased by certain amount, let us say 600, if the certain amount of provision is decreasing, then we have to record in the credit column. Okay, and if uh, outstanding expenses or Sunday creditors are also decreasing, let us suppose that they are decreasing, okay, then we record in the credit column. But if they are increasing, now sundry creditors and the outstanding expenses, if they are increasing, then we have to record in the debit column. So as you can see here, I have marked with this red red color, okay. A minus and L plus, and A plus L minus, isn't it? So it means same only. See this. Increase in assets, that is A plus in the credit column. Okay. Decrease in liabilities, that is L minus, which is liabilities decreasing, asset is increasing. And the same goes here also. A minus means decrease in assets or asset is decreasing. L plus means the liability is increasing. Okay. Now we already know that this revaluation account is a nominal account by nature. Okay. So if the credit column is more than the debit column, okay, if the total side of this credit column is more than the debit side, then the balance should come here. The balance should appear in the debit side, isn't it? So at that point of time, it is the profit on revaluation. Okay. If the total of credit side is more than the debit side, then the balance will come here. Then it is called profit on revaluation. Okay. Now if the total of debit side is more and credit side is less, then the balance will appear in the credit column or in the credit side, and that is the loss in revaluation or loss on revaluation. Okay, thank you for watching.